Advanced Financial Accounting. In this presentation, we're going to work a practice consolidation problem where we have P and S, the parent and the subsidiary relationship. P owning 100% of S. Some of the new items we will be dealing with is the land having a different value, a different fair value at the point of purchase than the book value. So we're going to have to deal with that. We also have the purchase of stock with the issuance of stock. In other words, P purchases the stock of S, but doesn't do so with just cash, but rather does so by issuing stock from P. Also note that we're going to be doing the consolidation as if it's 1 year later. So the consolidation or the purchase took place in January. We're going to say exactly 1 year later in December is when we're going to be doing the consolidation. Therefore, we will be dealing with those temporary accounts, those income statement accounts within the consolidation process. Get ready to account with Advanced Financial Accounting. Here we have our information. We have P is going to be the parent company, purchases 100% of S outstanding common stock on January. So we're going to say at the beginning of the year for the issuance of 41,000 shares of stock. So in other words, again, P is purchasing S, is purchasing S's common stock, but rather than paying cash for the common stock, P is issuing shares of their stock. So the issues of the shares being issued are 41,000 shares, par value 30, fair market value 57.50. P uses the equity method to account for S. So in other words, if we looked at P's books over here and we considered the investment in S, how did that number get there? With the use of the equity method. We'll consider that more later. And that would be the standard method that you would assume most of the time unless said otherwise. In other words, P could carry at cost, but you would think equity would be the way most companies would go, the most proper way to go. And then book and fair value of S accounts were the same except for land that had a fair value of $152,500. So now we're going to say, all right, at the point in time of purchase, not now, this trial balance over here is a year later. We're combining this a year later. Now note that in practice, of course, we would have the information at the point in time of purchase, and we could just look at that data. If you're looking at a book problem, oftentimes you're limited to the data, right? And all we have is the trial balance as of the end of the second year. So now we have this trial balance for S end of the second year. If we were to take the book value, assets minus liabilities, or the equity section on the balance sheet, then we're saying the book value is going to be equivalent to the fair value, except for, and remember, because we're doing a consolidation, we're basically kind of revaluating these items in a similar fashion as we would if there was a purchase taking place. We're saying every line item is the same book and fair value at the point of time of purchase, except the land. Land on the books here, $302,000. We're going to say it had a fair value of the $542,500. So that's going to be a difference that we'll have to be dealing with at a later time. Now let's also think about the goodwill. So there's two things we have to think about here. One, was there any difference in book and fair value that we're going to have to be dealing with when we do the consolidation? And two, was there goodwill involved? To think about the goodwill, we can then see our calculation down below. So first of all, I'm going to sum these across. So we're just adding up, this is P's books, this is S books, we're going to be summing those across. Then of course we'll need to be doing our elimination entries. Now let's consider the goodwill calculation. We're going to say that the book value is the $2,117,000. Now how did I get that number, you might say? Because in practice, where would we get that number? I would look at S's trial balance or balance sheet or whatever from the prior year. But this number that the problem is giving us is in the current year. So how can I get to this book value as of the last year? Well, because it's only 1 year later, note that a book problem could ask you something like this, and you would basically say, all right, it's got to be down here in the equity section. So note that the common stock since the point of purchase a year ago hasn't changed, and the additional paid in capital should not have changed for S since last year, the beginning of this year. And the retained earnings should not have changed either. Why? Because at least on the trial balance, net income has not yet rolled into it. The temporary accounts are broken out down here, and dividends have been broken out. They're not included in this retained earning number. Therefore, if I was to add up the common stock, the retained earnings, and the additional paid in capital, these items, that would be, you would think, the book value as of the beginning of the year. So if I was to take out the trusty calculator, then let's take out the huge calculator. Calculator gets excited when you pull out the calculator. So we're going to say that we have the 123,000 plus the 173,000 plus the 714,000. That's going to be the 217, the 2,117,000 here. So there's going to be our balance, and then we're going to say that the difference in the fair value of the land, which is the 542.5 minus what it's on the books for, assuming there's no purchase since the point in time that this took place, the 302, is the 240,500. So we have to adjust for that. That means that S fair value of net assets at the point in time of purchase, not here, not on this trial balance because this is a year later, but at the point of purchase, which in this case was a year ago, is 2,357,500. If we compare that to the issuance of stock, now you might say, hey, look, if I was to revalue all of the assets and the liabilities, then that's what the purchase price should be if I did a good job of doing that. And if I don't know, for example, exactly what the stock cost was on a fair value basis, because it may not be as easy to do unless it's publicly traded, then I might say, hey, look, I'll just value the stock at whatever the book value was or the fair value was of the assets minus liabilities. You can't do that. Why? Because even though we did a good job revaluing the assets and the liabilities to this amount, there could be something that we are paying for with the stock or with this transaction for the purchase of stock that is not included at all over here. So we couldn't have revalued it because it's not on the books at all. That's called goodwill. So we cannot just then look at this other side and just say, well, this must be the same number. What we have to do is fair value this as well. So now P is not paying cash. In other words, they issued stock. So they issued stock, and the fair value is $57.50. If it's publicly traded, that would be easy to know. If not, we'd have to kind of estimate that somehow. If they issued the stock for $57.50, it would be that times the 41,000. So if we took out the trusty calculator, of course, I'll do the calculation just to verify that. 41,000 times the 57.50. That gives us our 2,357,500. So that means that we don't have any goodwill. So we purchased it, we made the purchase price not for just the book value. We're going to have to still revalue this land, but we don't have any goodwill that we're dealing with in this case. So that's nice. Now let's consider this investment account. Now, how did that investment account get to the 2,739,000? It's using the equity method, but let's just kind of review the equity method so that we have a good idea of that as we think about these adjusting entries. So when it was put on the books, we as in P, debited 2,357,500 and issued stock for the 1,230,000, which is the 41,000 times the $30, the par value, the difference being the amount that went into additional paid-in capital. Because remember, this original investment was for 41,000 times the 57.50. So it went on the books for that 2,357,500, because in essence that's what we paid for it. If it were cash, then you would be like, we credit cash and debit the investment. This case we credited the common stock. Then we had the investment because the income for S, which is revenue minus expenses, was at 587,000 under the equity method. P then recorded that 587,000 in the investment account and in income. So we could see it was included in here, and we could see it right there because they own 100%. Then we know that S then issued dividends of 205,000. So who did that go to? Well, it went to the owner, which is P. So P got all the dividends. So cash went up there, and then the investment here. So how did that number get here? How did that 2,739,500 get there? Well, this was what happened at the beginning of the year, because that's when the purchase took place. Then we increased it by the revenue because they own 100% minus the dividends. That's going to be that 2,739,500. Okay, knowing that, let's then now do our journal entries. So considering our journal entries, we know that this investment account needs to go away. Now, I would often think about this investment account like with one big journal entry. However, it's often useful to break it out too. So you could think about this in two different ways. So note that I didn't put a credit here of the 2,499,000. Pretend that I didn't put anything there right now, and we're going to use this as the plug. So I know I'm going to do something to the investment. What I'm going to do is whatever I need to do after I do the other side of this transaction, which is to remove the equity section for S. So I'm going to basically think about removing the equity section for S, which means common stocks is going to go off the books. So I'm going to say I'm going to debit the common stock for that 1,230,000, removing it. So here's P, here's F, S, here's the total. Then we removed S to bring it back to P. Then we're going to do the same for the additional paid in capital, so that we're going to debit additional paid in capital. If we record that, here's P, here's S, here's the total. We removed then the additional paid in capital for P, bringing it for S, bringing us back to the 8 additional paid in capital for P. Then we're going to do the same for the retained earnings, the 714. So 714, if we record that, here's P, here's S, here's the total. Here's us removing S's portion, bringing us back to P's portion once again. Then we're going to do the same thing for the dividends. So dividends are debit here. So that's 205. We got to remove that. So we're going to credit the 205. If we then record that, we have the P portion, the S portion, the total. Then we remove the S portion to bring us back to the P portion. Then we're going to have this item down here. So we removed kind of the equity section here for S. Then we have to think about kind of like the equity or section or the income statement, the net income here. Now, we're not going to remove each line item because notice this 587 is there. However, it's duplicated. Where's the other side of it? It's been recorded here on P. P reflecting the entire thing given the fact they used the equity method and that they own 100% and it's been the entire year. Therefore, we're going to remove this account, the income from S. So there's the income from S. Now, that is going to be our first journal entry. So note that this item up top, you want to think about that as kind of a plug. So in other words, pretend I did that last, right? If we took the 1,230,000 plus the 173,000 plus the 714,000 minus the 205,000 plus the 587,000, that's what the 2,499,000 would be. When we record that 2,499,000 here, doesn't quite do it for us, leaves us with that 240,500. Why doesn't it do it for us? Note that it would have done it for us if we had a practice problem like we had in the past, where the purchase took place for the same amount as the book value of the amount that was being purchased. In this case, that wasn't the case because land was valued at a different value. We didn't have any goodwill, so that was good. That's not going to be a problem for us. However, the fact that we paid more than the book value is going to result in this problem, and we're going to show that in a separate journal entry. So let's look at the next journal entry, which is going to clean this one out. So we're going to say, and there's this account went down to 0 now. So then we got the land. So we're going to say we have to revalue the land. So you'll recall that it was 240,500 higher, as we saw in our data. So now the land was on the books for the 945 plus the 240,500. So that brings it up. That makes sense. Notice land isn't depreciable. So when they deal with land, we don't have to deal with depreciation, which is a problem. And we'll deal with depreciation later. And then we have in a later problem, not in this one, investment in S. So then the investment in S, and that should take care now of this item. So those two amounts for the investment in S now bring it down to 0. So that's what we would expect with that account. So note, we're kind of breaking this out into two journal entries. In practice, I would often think of this as one long journal entry. In other words, I would take this off the books for the full amount at the beginning and then take into consideration the land as I do that, which is one big journal entry. But you can see why 2 journal entries might be useful here, because this first journal entry kind of ties into what we had done in the past, to the assumptions that were made in the past when we didn't have the revaluation that was necessary, and then you can see the revaluation. I think in practice later on, it's actually a little bit easier just to make one long journal entry taking all these things into account, and that's probably what we will do in future practice problems. Also note that we didn't deal with the accumulated depreciation journal entry as we often do in the past, because we kind of put them together, the building and the machinery, in one line item instead of breaking out the accumulated depreciation. So that's why you're not seeing that, but we've seen that in the past. We'll see it again in the future. Also note that I highly recommend working these problems in Excel as well, so you can manually start to record these things. I think it's easier to retain the information a lot easier if you do that.